Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video will examine the frequent question of paying down or paying off a mortgage versus investing. This is important now more than ever with interest rates and mortgage rates increasing. So looking at the investing first, depending on what you're investing in, you'll get, let's say, 8 to 10% on the average in the major indexes with volatility before tax. So you'll make a pretty good return with the investments, but there'll be ups and downs with the possibility of negative years depending on what you put the money into. Paying off your mortgage, you'll get whatever the mortgage rate is, but you'll have paid taxes on the money first, so the return is actually a bit higher. So on a primary residence, by paying down your mortgage, you might be saving 3% interest, but you're actually saving, depending on your tax rate, let's say 5% before tax, gross income money, because the mortgage is getting paid with after-tax dollars. Paying off any investment property will lose you the chance to write off the interest, however, so that is an additional cost. A typical investment in a stock index will earn you more on the average than the typical mortgage interest you'll be saving, but the stock will have volatility while the interest you'll be saving is constant. If you are debating whether to invest or pay down a 20% interest rate credit card, debate no further. The savings by paying down the credit card will save you much more in interest than any stock market could make you. It's also a personal decision. If you hate debt and don't want to owe anyone anything, pay off the mortgage to feel comfortable. The risk that the mortgage brings to you is reduced if you are afraid of losing your job and your house as a result. In this case, if you happen to have a lump sum of cash, you may consider holding it as an emergency fund, so if you lose your job, you can continue paying the mortgage. If you throw the money into the mortgage and then lose your job, you'll have paid down a mortgage, but still lose the house when you can't pay the monthly payments. This is, of course, assuming that you do have a lump sum to invest or pay down the mortgage with, not if you are making the monthly payments and putting in a little bit extra. You can also look at investing your cash instead of paying down the mortgage as borrowing to invest. Since your mortgage could have been lower and since it wasn't, it is as if you withdrew the money from your mortgage. If you're not comfortable with borrowing to invest, then pay down the mortgage. Borrowing to invest multiplies the returns and the losses by using leverage, which is the subject of the video in the upper right, using leverage to invest. This adds risk and possible reward. Ultimately, whether to pay off a mortgage or invest is a mathematical and a personal decision, and highly depends on what returns you think your investment will earn you and how you feel about being in debt. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.